Cool. Welcome. Happy Monday, guys. Thanks for joining me on a Monday. I know it's not the most fun thing in the world, but hopefully this will be helpful. We can keep this as short or as long as you want, but just to kind of walk you through trading comps. And, I think when you're studying the technicals of how to apply to investment banking or hedge fund roles, you think of these things as very separate technical abilities. But in fact, most of what this is, and you'll see it, is just knowing how to go through the filings and knowing how to calculate basic finance concepts. So it's a good review. Probably new for some of you and basic for others of you. So I did Apple, if you saw in the template. So let me share this template. Screen. So I did this example on Apple, right? And we can walk through Apple, and then we can do a new company, and then we can just open it up for questions if some of you have already kind of taken a stab at it. Is there a company that you guys might want me to, would you like me to walk through Apple or just do a full new company with you? Actually, let's do a new company. And so this will be kind of like a 2-company trading comp. We'll do Apple and maybe Google. So Alphabet. So, again, for those of you watching after the fact, what trading comps are is a set of related companies that you spread next to each other. So this example would be kind of the big FANG stocks. So you kind of go like Alphabet Inc. You would go, maybe Facebook. Maybe do, it depends on kind of what you're looking for. If you're trying to do phone manufacturers, you might actually go like Samsung and LG and stuff like that. But if you're doing like big software companies, it might be Alphabet, Facebook, maybe Netflix, maybe a couple other ones, right? If you're doing kind of a FANG one. So the whole point of it is to just have a quick sheet in the industry. So whether you're investment banking or you're kind of at a hedge fund or private equity fund, you want to see where companies are trading and, also understand why they're trading at a premium to each other or a discount to each other. And a lot of private equity uses this, right? Because if I own like a industrial manufacturer that makes, I don't know, like car axles, right? I would try to spread a bunch of public axle manufacturer companies, or at least tier 1, tier 2 auto manufacturers that are publicly traded, just to kind of understand what my company might be worth in the public market. And, how my company, if my company has a 20% EBITDA margin, how that compares to other peers, right? So it's basically comparing companies to their peers. So this is kind of the kind of end result of a very basic trading comps. We have, the current share price, obviously, which doesn't mean too much, in and of itself. The kind of 1-year return, has it been doing well or not over the last year? Percent of 52-week high and low. So if it's almost 100% of its 52-week high, that means it's almost at all-time highs, and it's kind of been going up and it's kind of making new highs. If it's close to 100% of 52-week lows, that means it's been trading down and it's kind of a downtrodden stock, right? So this allows you to kind of get a nice little picture of, how has the stock price been doing over the last year? And has it been a steady move up or kind of a choppy move up or choppy move down? And then there's market capitalization, which is the value of all of its equity. And then the net debt, which is the value of all of its, debt minus cash. The reason why we do net debt is because conceptually you have a bunch of debt outstanding that you owe lenders, but you also have cash on your balance sheet. So if you wanted to, tomorrow you could use that cash to pay down the debt, and that's kind of like your net debt, not gross debt. And then there's other things that go into enterprise value. So it's preferred stock. So that means if you have kind of another class of stock that's above the common stock, And then minority interest is like, or also called non-controlling interest. That's kind of under accounting rules. If a company owns a minority of another company or other kind of assets, they're not really included in financial results. But they still own, like, let's say Apple owned 25% of Foxconn or something, right? Which is a manufacturer in China. That's still value that is valuable to the company. It's just not consolidated on the like income statement. So, you should add that. So enterprise value is essentially the how much the whole company's worth, right? So, I mean, again, going review, a lot of you already know this on the call, but hopefully some of you are tuning in later. So enterprise value is like, think about it as like if you own a house, that's your house's value. If I own $1 million home, my enterprise value is $1 million. There's all this debt, right? And then, so that's like your mortgage. And then what's left is equity. And then companies have just different types of equity, right? So it's like this type of equity, preferred equity, common equity, and then minority interest is just another concept in corporate finance that we don't find in like real estate, or at least single property real estate. Cool. So all that work, which we'll get to all that, gets us to the true enterprise value. So what I wanted to show you is, right, if I go to, doing some research here, if I go to Apple, right, the reason why these tools are really expensive is because they try to calculate enterprise value and market cap for you and all these other things, and they try to pull it from filings using like machine learning, AI, and ability to understand like filing English and whatever other language, written language. And they try to add all that up and get to the enterprise value. And a lot of people ask me, is AI going to take away the job of a financial analyst? And well, let's just see, right? So this is a very expensive tool. It's not the most expensive tool. Their computer is calculating Apple's enterprise value at 1.8 trillion, right? And this is how they calculate it: market cap, long-term debt, capital lease. Oh, I forgot capital lease is in there, but usually it's kind of, long-term. This is just more debt, cash equivalents, short-term investments, other debt. See, so all that to say, right? And I'm calculating it a little differently. I calculate them having about 2 billion in enterprise value. And a lot of times the difference is the programs have a tough time diluting like all the options and restricted stock units. And just as a conservative investor, we want to err on the side of just over diluting ourselves to understand, just like, just kind of an extra layer of conservatism. So obviously arrived at relatively pretty different answers. So here's enterprise value. And then we use this kind of enterprise value to see how cheap or expensive the stock is. So, and what do we base that on? Is it based on revenue, based on EBITDA, which is a proxy for cash flow, or is it based on EBITDA minus Capex? So EBITDA minus Capex to me is the easiest quick proxy for cash flow. So it's EBITDA minus the capital expenditures they make annually. So that's kind of a good proxy for cash flow. And that's what private equity likes to use a lot. And then we get to see EBITDA margin, right? So, the higher the margin, the better the business generally. The lower the margin, the worse the business. Cool. So let's just do Apple. Let's do Alphabet, right? Actually, let's do Facebook. For a look. So ticker FB. Okay. So the share price stuff, that's pretty easy to find. You go to like Yahoo Finance. Because I know, most of you aren't going to have Centio. Some of you have Bloomberg. But again, the whole point of this, first of all, accuracy is key, especially in the industry, especially when you're starting out. Like, I may tell you that like it really doesn't matter too much on a personal investing decision, whether or not this enterprise value is 2 billion or 1.9. Like, at the end of the day, to me, it's either overvalued or undervalued for such a great business like Apple. And whatever, 5% difference isn't really going to like make or break the investment. But when you're working for investment banking and you like really want to cut your teeth on the skills, accuracy is key. So one of the biggest pieces of advice that I could give you once you guys all go in the industry is like triple check your work. It's all about accuracy. Like they would rather have a slower, I guess, less speedy, less strategic thinking analyst, especially starting out, that gets all the numbers right and knows how to do everything and delivers the right quality content or quality work product than someone who's super intelligent and doesn't do the basic level work, because we all have to kind of pay our dues. So just FYI, going through all this, you want to like double, triple check. And again, this is, for now, it's an internship, hobby, kind of working group. But when it's on the line, just triple check your work. Cool. So again, this kind of share trading price stuff should be easily found on Yahoo Finance. I'll show you how to do that on Facebook. And again, I can do it on Sentio, but let's just do it here. So the last trading price. So the first thing you want to do is update to the date you want to. So let's open up all these tabs, right? Actually, I'll do that later. The date that you're updating it, right? So it's 8/10/20. So that way, whoever's reading it, I already made this template for you guys, so it kind of flows all the way through. But people know, as of this date, this is what it looks like. But if I'm looking at it 3 weeks later, I kind of recognize this might be outdated numbers. So as of 8/10, as of close 8/10, Facebook's trading at 263. And another piece of advice, wherever you can, copy and paste. We all fat finger inputs. You always want to copy and paste where you can. Okay, so that's 263. 1 year return, different, whatever. So different. So here's 1 year. Here's 163. And if you hover kind of 163, I mean, right, if apparently this UI is not letting me go to today, but let's just use yesterday. It's not really that big of a deal for us. So actually, why don't we just go? So this is the 1 year view. It's so weird. It's not letting me go. Anyway, whatever. We'll just go as of yesterday. And so do you see that 42.9% change over the year? Do you all see that? Cool. So that means that 1 year Facebook chart, you just hover over it. I mean, you can do the calculation yourself. It's the latest stock price divided by, the stock price it was a year ago minus 1. It's just a percentage increase or decrease. That simple calculation. So we'll just use 42.9%. It's probably more like 40, but whatever. 42.9%. And then percent of 52-week high, we kind of have to go back to the Yahoo Finance page. So here, the pretty standard thing to quote is 52-week range. So that's like 137 is the 52-week low. So that means over the last year, the lowest price Facebook has seen is $137.10. So we go equals this divided by 137.1 minus 1. Oh, actually, no, because it's just a percentage, right? I did it on the wrong one. So I'll change this up for you guys because it's more confusing. Okay, cool. So that means that as of today, Facebook is trading at almost 200% of its low. So if you had bought it over the last year at its trough price, you would have almost doubled your money. That's what that means, okay? Percent of 52-week high. So it peaked out at 278.89, and we just saw that was actually like yesterday. So we just do the same calculation. Equals current price divided by 278.89. So that means, it's trading near the top, right? Near its high. So, I mean, that's pretty simple enough. Any questions? No?
I just have one question about enterprise value multiples. I
Yep.
was just curious, you said that EBITDA minus Capex is sort of like a proxy for cash flow. What's the advantage of using that figure over just free cash flow?
So yeah, let's actually dig into that. So let's see if I still have. Okay, so free cash flow, right, is you go to the cash flow statement, right? And conceptually, free cash flow is basically just cash flow from operating activities and investing activities, right? But unfortunately, right, so what you have here is um, a bunch of noise, right? So if the company buys a bunch of um, free cash flow as it's generated automatically, if we just go cash generated by operating activities minus investing activities, right? Or plus investing activities, right? We would think that Apple has, 113, 114 billion in free cash flow for that year, right? Which is, it's true, it has basically 114 billion in cash inflows from operating and investing activities. But what we don't want to consider in our concept of free cash flow is the fact that Apple bought $40 billion in marketable securities. That means like treasury bonds or whatever they're doing with their cash, or just even like whatever they're buying, right? And then they're also selling a bunch of these marketable securities. This has nothing to do with their business, right? What does have also, if a company is acquiring a business, it's like that you would see a huge cash outflow for that year because it spent a bunch of cash to buy a business, right? But that's not what we're trying to find. We're trying to find what the core business can generate on a free cash flow basis on a steady state. What is just that business creating? Not like outside of any like financial purchases or hedging. There's a lot of hedging that happens outside of acquiring what we call inorganic. So like acquiring things, another company. We don't really want to consider that because that's like usually a one-time thing, right? So a lot of companies also report adjusted EBITDA, and they try to adjust EBITDA for like one-time expenses. They always argue, and sometimes you can believe them, sometimes you can't, or they kind of stretch the meaning of it because they're like, oh no, like we have all these restructuring expenses that you should add back, when in fact they do that every year, right? So okay, my mic is like, hold on. I'm like in between places, so apologize for the noise. Can you still hear me? Cool. So all that to say is, right, you're trying to find the core business. Another reason why we don't do that is because a big part of cash from operating activities is the changes in net working capital, which is here. So if you have a business that requires a positive inventory. So let's say you are Nike and you basically have to you have to basically make a bunch of stuff and have a huge inventory before you sell it. The more sales you do, the more cash is stuck in this like kind of balance sheet net working capital concept, right? So EBITDA minus Capex is just saying what is the cash flow of the business outside of any like financial asset purchases, acquisitions, outside of any like balance sheet movements, right? It's like what is the business generating cash generally, and you minus Capex, right? Generally. So and it's supposed to be a quick way. So if I think you're right, William, my favorite metric of all, especially for value stocks, is free cash flow yield. But the question is, you should probably calculate free cash flow yield yourself, and you should probably average it over a longer period of time, just to smooth out any of these kind of extraneous things that you're trying to, like, obviously strip out all this other stuff, right? All these marketable security stuff, because I really don't care if Apple spends a bunch of cash to buy like certificate of deposits, right? Because to me, CDs are like cash. So hopefully that answers your question.
Yeah, that's good. Thank you so much.
cool. And yeah, again, this is supposed to be quick, because if I told you go find me adjusted free cash flow for like 30 companies, like it would like triple your time. Cool. So okay, so we explained, you know, the trading pieces, right? So let me move my screen. Obviously, this in itself doesn't really tell you anything except how the stock has been trading. Is it near its highs? Is it near its lows? Is it on a tear? Here we see Apple's been outperforming Facebook. So it's kind of a good quick thing. These are, yeah, William. Oh, is this? Do you have a hand up?
Sorry, that was from before.
Oh, from before. Oh, sorry. So here we see Facebook's been trading, had been underperforming Apple by like a third, right? Advertising, which is super interesting because it's like, okay, so now like the like analyst in me really starts thinking, once we see this, it's like, why is that the case? Why would Facebook be, you know, underperforming Apple through COVID, you know, when Apple is seeing weak hardware sales? They had to close their stores, but Facebook is seeing a lot of like advertiser loss too. So we don't know, right? So we can find out. Like then it's more digging. So now let's figure out market cap. So in order to get to all these, what we're trying to go for is the valuation, right? This is what we want, but before we need to do that, we need to calculate a bunch of this stuff. So here we have market cap. So in order to calculate fully diluted market cap, we need like fully diluted shares outstanding. We call this kind of, I just said fully diluted units, but you can do fully diluted shares outstanding, FDSO. That's a common terminology. And I did these for you, but I'll just copy them down as we go. Hold on, I gotta adjust my mic. Okay, so how do we find common shares? Pretty easy, right? So the two things you need to do this are, so Yahoo Finance is the first one, but the other two things you need are the 10K and the 10Q. So the 10K is your fiscal year annual report, and your 10Q is the quarterly report. So there's 3 quarterly reports a year in the US. And Joey, obviously there are different ones for international, but they're usually kind of a similar method. So 1 annual and 3 quarterlies, right? So you do the annual, 3 quarters afterwards, and then you do another annual. And then that comprises your 4 quarters. So if you don't have Sentio, no problem. All you got to do, or if you don't have Bloomberg or CapIQ or anything, all you got to do is search Facebook, investor relations. If it's a big company, if it's not, then you go to SEC Edgar. If it's like a small cap stock and they don't have an investor relations page, you go to company search and then you look it up. So like if I go small company, like, or I guess just for this sake, I go Apple, I can search the Edgar filings, and then, you know, I basically look for 10Q or 10K. And then you can search it. The Edgar just sucks. So I go 10K because I don't see it immediately, and I go search. And then here they are, right? So then here you can download them. I usually like downloading them as a PDF, but you guys can do whatever you want. But personally, I just like going in their investor relations site. It's usually prettier, usually a little bit more. They have their press releases. They have the call transcripts, which are huge. That's a big thing you do as an analyst, is you read their calls, because the management team will talk about things about the business, like, and contextualize the numbers, because the numbers themselves can't really tell you everything. And then analysts will join the calls and ask very insightful questions, like where do you expect this to be? They'll give guidance here. So read the calls for sure. It's also the interesting part of the job. So from here, I'm looking for SEC filings. So I go financials, SEC filings. So here's the second quarter. See, you get everything you want. Form 10Q. Oh, they're only giving it to me on, okay, HTML. Annual reports. Oh, actually, sorry, SEC filings here. Perfect. Annual filings. Here it is in PDF. quarterly filings. Here it is, the latest 10Q as of July 31st, which is 10 days ago. Pretty cool. So what I like to do is I don't like reading it in the browser, right? So I download that. I don't like this in the browser. Download that. So 10Q. Yeah. Downloads. Pull that up in Acrobat. Cool. So this is the 10K, right? And 10Q. So what do we need? We need the latest common shares outstanding. And for those of you watching online, I guess I'll put this up in ROIC in case you all want to make your own comps. I don't necessarily see a lot of individual investors doing it themselves, but maybe they want to. Okay, so common shares outstanding, it's not going to be in the 10K because we want the latest number here, right? Because this 10K was filed as of December 31st, 2019, which is obviously 8 months stale. So we want the latest. So we go to the 10Q and we go to basically it's usually on the first page, but you can just Control F is going to be your friend. You go or shares out, and then a lot of times it'll be number of shares outstanding. You got Class A and Class B. Okay, so this is interesting, right? So if you have multiple classes of stock, then now we have to pop out to the footnotes. So you always want to read all the footnotes if you're being like a really deep analyst. Go all the way down. So the way the footnotes are structured, generally, is you guys know what the three financial statements are, right? It's the balance sheet, the statement of income, so the income statement, and cash flows. And the footnotes will be about each item under these things, generally in order. So where would we find out what kind of classes of shares they have? The answer is under stockholders' equity, right? Because that's equity, right? So it'll probably be under. So usually we want to look on the balance sheet. Here they say we have common stock. We have so 2.407 million shares outstanding. Oh, so sorry. So we're looking for June 30, 2020. So this is June 30, I'm sorry. So it's a month ago. So 2.406 million as of June 30 for Class A. And 444 million outstanding as of June 30. We always want outstanding. So not authorized or issued. We just look for the ones outstanding. That means the shares that are already out. So let's go down to I want to know more about these Class B shares. If I had to guess, they're Zuckerberg's shares, and he has like a bunch of control. But just go down. So if I'm going to cheat, I go because you guys should definitely read 10Ks, and the only way you understand your way around a 10K is reading a lot of them in 10Qs. But after you know that, you can just Control F and go shareholders equity, or I guess it's stockholders equity maybe. So we'd want to read a bunch of this stuff. Class A stock. We'll come back to here. But for now, I'm just going to go Class B, and I want to understand. Okay, dual structure. Class B has 10 votes per share of Class A. 10 to 1. Again, Mr. Zuckerberg, I kind of knew this, right? Mr. Zuckerberg owns, even if he doesn't own a majority of the company, he owns quite a bit of voting power. So for that, if they're pari passu, which means they're equal in cash flow, then we'll just treat them like the same. So transfers by holders of Class B common stock will generally result in those shares converting to Class A stock. So from a really quick read, again, accuracy is key. So I'm just going to run you through this stuff quickly. From a quick read, we're just going to treat them the same, right? So I have this trick. You hold Alt down, you copy paste, and we want to convert this to millions. So just kind of paste that, sum it up, copy, and then copy it as a value, convert it to millions. So they have 2.85 billion shares outstanding. And then you always want to add footnotes where you can. Class A plus Class B owned by Zuck with 10-1 voting. Right. Cool. So the thing is, common shares aren't the only thing that is equity, because they issue restricted stock units, performance stock units, and options. And do you guys know what options are? Options are the right, but not the obligation to buy a share at a certain strike price. So if I do that, the company, if I owned an option of Facebook for $200 a share, I would have to pay $200 to Facebook in order to exercise my option. And then, once I do that, I get a share of Facebook, which is worth $263. So that's in the money, right? I would want to do that, or just let it ride, depending on when they expire. But if it's out of the money, so I have to pay you Facebook $200, but your share price is only, or let's say I'm struck at $300 and the share price is $263. I would never want to do that, because why would I pay you $300 for one share of Facebook when I could go on the public market and buy one share of Facebook for $263, right? So my option is worthless. So we call that out of the money. I know I'm repeating myself, especially in COVID world where every Robinhood trader knows what an option is. But essentially all that to say is it doesn't fully dilute the share price, or the shares outstanding, because I have to pay the company cash. So let's do this. What I like to do, just for simplicity's sake, I treat RSUs and PSUs as just fully dilutive, right? Conceptually, what an RSU or a PSU is we're going to give you just straight up shares in the company if you stay here long enough or you perform well. So I just like to assume that they hit all those hurdles, right? Again, it's kind of the 80-20 rule. I guess I could do more work on it and be slightly more accurate, but generally I just like to err on the side of being more conservative. So I go restricted. So here we see 1.106 million unvested RSUs as of June 30, but that just makes me think there are vested ones. So,
hey Justin, just a quick question there: the difference between vested and unvested, just on a high level.
Yeah. So unvested means that if I'm an employee and I'm working there, they'll give me 100. Let's say they give me 100 RSUs, but the RSUs vest over 4 years. That means that I have to stay there for 4 years in order for all of them, in order for me to get them, right? So, I'm so dumb. It's late. So RSUs are a little different than options, right? So options, you can have vested options that aren't exercised, or you can have unvested options that, obviously you can't exercise an unvested option because you're not allowed to. RSUs are a little different because they're straight up just giving you shares of Facebook stock, right? So if I gave you 100, if you're a programmer at Facebook, and I give you 100 RSUs, I would give you, but you have to stay vesting over 4 years, and in equal annual installments, you would vest. I would give you basically 25 shares of Facebook stock every year that you work here, right? That's what it means to vest. It's you kind of, to vest something means you've fulfilled your time commitment. But the reason why we still track this as dilution is because like it's an obligation to create these shares if people stay, which a lot of them will, right? So it's weird for RSUs, PSUs, if they are vested, they're already created. So there's no such thing. I forgot. Basically, you wouldn't have a vested but unexercised RSU because once your vesting date, they'll just give you those shares. And I don't know I've never worked at Facebook, so the mechanics of which I'm not sure if they like hold it for you in a Schwab account or they give it to you in your Schwab account. I don't really know how that generally works because I've never been given RSUs. I've been given options before. So anyway, so now we have RSUs 106. So you go in here, but you convert that to million, right? So I just like to fully dilute that, okay? And now we have options, right? A lot of these Silicon Valley companies don't have options. They like RSUs because they're better for employees. Like I would rather have an RSU than an option, right? So an RSU, you're just going to give me a straight up share of Facebook stock, right? Each one of which is worth $260. An option is like, oh, I have to pony up money to buy to like exercise this option, and I get the profit of what the share price is now minus what I pay you, right? So I would rather have RSUs, but let's just see if they have options, right? Stock options. See, I mean, from first glance, they don't really have any. But if you do have them, what you do need to do is they're not fully dilutive like an RSU or PSU is, right? Essentially, if everyone stayed there for 4 years or whatever it is, all these shares would be created, and then this count would go this plus this, right? All they have to do is wait, or all they have to do is perform. Options are different, right? If I have an option, if a lot of times if you search stock options, they'll give you a table like this, and it'll say number of options outstanding and weighted average strike price. Okay. So all you got to do with this calculation is copy this formula here, and I already did it for you. You go number of options units 100, and the strike price is 200, let's say. So that would mean that the dilutive effect is 24 million, not 100 million, because the math is it assumes that Facebook gets paid the $200 for 100 million options, and then they use that money to buy back shares in the open market. So the net dilution effect is actually just this. So if you see options in an option table there, just plug in the numbers, and then if you still don't understand the concept of treasury stock method, it's called TSM. So just look up treasury stock method. Just read this and then talk to me if you still don't understand it. And then just message me on Slack if you still don't understand it. But definitely read this first, okay? Save both of us time. Cool. So again, these tech companies are cool to work at. Maybe I'll go work at Facebook. Just kidding. Just kidding. To my CEO, I'm not going to Facebook. Okay, cool. So that's all that, right? So let's copy that down. So fully diluted shares outstanding is common shares plus the restricted stock units and PSUs. That's just my method. I like to just be overly conservative with it. And, you can discount this if you don't think that you can do times 75% or whatever. And then whatever options dilution there is, which there are none, and there wasn't any in Apple that I saw off a quick glance, nor enough to warrant me spending another hour hunting that down. So that's the fully diluted shares outstanding number, right? And so now we take this number, not this number. We multiply that by the current share price. And we see that Facebook is trading for a lucky $777 billion market cap. And now let's compare that to Sentio. Time flies, already been like 50 minutes. Okay, so their market cap's a little different, 749.2. So if I delete this, does that turn into 749? Let's see. Yeah, it does. See? The AI didn't catch the RSUs. Okay? This is why we do it. It's like, as a personal investor, do I ever do this? No. But like, because honestly, like, if it's, whatever. But I would like it if someone could do this for me, for sure. And again, for those of you watching, hopefully we have all this going on acouplecents.com. Like, hopefully it's like, as a community, we can have kind of cool, like, sort of institutional level tools for ourselves. But as you saw, right, their number is wrong. And if you look it up if any of you have access to Bloomberg, I guarantee you it's not going to be completely right either. Cool. So we're done with market cap. Second piece, hopefully it's easier. Oh, David.
Yeah, so I think like I was doing this for like net debt, and I think a lot of the places where I was like, I have Bloomberg, and I was looking at that, and they included like operating leases as part of debt.
Yep.
It's not really debt, but like, is that somewhere a case where like maybe like the AI does adjust for those kind of things?
Yeah, we can put it in. A lot of heavy industrial businesses have like operating leases that they are on the hook for. TV here, they don't include, they're not including capital leases. I was taught it was include capital leases or capitalize operating leases. It's funny that you say that because I think they changed the accounting rules. Capital lease accounting.
Yeah, they changed the accounting rules. There's now like a finance lease and like the operating lease or something like that. And before you didn't have to include it on the balance sheet, but now it is.
Yeah, now
So,
I think, yeah, like, so there's a whole thing here. Let's go through that together. Okay, let's do Facebook's, and I'll show you where it probably will be.
okay.
Okay, so what I do is debt, long-term debt. This is where I see it. Okay, so they have zero debt. This is the problem with using like a all cash tech company as your example. They have a $2 billion revolver, which is basically like a line of credit that they can draw on, but they said as of June 30, we have no amounts drawn, so they have zero debt. But let's go to their balance sheet right here. Okay, so we can't talk about debt here, but usually go to that long-term debt section, and you want to see what's a good company. Let's go to Apple, right? All this is still the latest 10Q, okay? Because that's the latest number for balance sheet stuff. So here we see the debt portion of the footnotes, right? What you want to look for is total debt, okay? Not total non-current portion. You want the total amount, okay? So that's why over here in the comps, I put 100, which puts to this number, okay? Total debt. But Facebook, our example, doesn't have any debt. Now, I was taught for enterprise value to include all forms of debt onto the business. All that to say, let's just do that. If it's a form of debt, then we should put it as a form of debt. Yeah, I mean, when I was learning all this, it was mostly off balance sheet. So we wouldn't really.
Yeah, they changed it last year. I think I read this exact article earlier.
I mean, I think for your industry and for those like Capex heavy industries, just include all of them. All right, cool. Let's speed through this. 10Q, cash, total cash and marketable securities. You can go to the balance sheet, but here's the fair value measurement. We're just going to do this. Footnotes are really great. $52 billion. Okay, so we see this. The sum of that is 58. Interesting. Okay, so in my opinion, I would probably go with this number. Just go this plus this. So just go to the balance sheet, add that up. Net debt. We have Facebook's net debt. Preferred stock would be under stockholders' equity. We don't have any, but if there is, you'd find that here. For now, just put the book value of that. Okay. And then minority interest, you'd find usually like in long-term liabilities or here too. I don't see any of that. So again, just put the book value if you see non-controlling interest or here, or if you see preferred stock or preferred shares, you see book value, let's just load that in. We can go as deep as possible too. I would just say for now, for us, let's just put the book value of it. It should be good enough to suffice. So now we see total enterprise value of Facebook is 719 as we calculate it. And what does Sentio have? 691. Yeah. So the difference is, right, remember they didn't calculate the dilutive value of the RSUs, PSUs. Cool. So we have our market cap, our net debt, and preferred, none of this. And then now we have enterprise value. Cool. So I did this for you all. So it's really easy. We want the latest fiscal year revenue, EBITDA, Capex, and then from the 10Q. So we have 10K and 10Q figures. So what you want to do is go to the 10K, go to the income statement. Revenue is easy. So go to 10K, right? So we're going to the last 10K, and you want to put in these dates. So the 10K, I go to financial statements, revenue, year ended December 31st. So 12/31/19. So here we have, and I have notes in here for you from Apple, so you can double check that. Revenue is pretty easy. Just copy paste that from the year. EBITDA, right? So EBITDA is income from operations or operating income. So this is that number, right? Equals operating income plus, so that's EBIT, another word for EBIT, right? We want to go plus depreciation and amortization, which you go down to the cash flow statement. So consolidated statements of cash flows. And we take D&A plus D&A plus stock-based comp. So that's a non-cash expense. This isn't this isn't purely adjusted EBITDA because we're clearly missing a bunch of like non-cash expenses that are lumped in here. And a lot of companies will report their own version of a Facebook EBITDA or like of their EBITDA. But the way we're going to do it is just do operating incomes or EBIT plus D&A plus SBC, stock-based comp, and then Capex. So Capex is, go back to the K, you go to the cash flow statement, so consolidated statement of cash flows, and go to purchases of property, plant, and equipment. Sometimes there will be another item here that's sort of like like Capex. So that has to do with their business. But so just look out for that. If there's like purchases of other operating equipment or something like that, you definitely want to include that stuff. But a lot of this other stuff is like purchases and sales of marketable securities, which are just financial things, and then acquisition of businesses. So we want to not include that. So usually it'll just be PP&E.
If there's a line there, like at least for me, some of them have lines where it's like disposal of PP&E, so it's not like net PP&E. Should we also include that? Like if they're, so like there's like a negative like acquisition of PP&E, and then they have like, they sell off, I guess in my case, trucks, right? And so they get some money back. Should we include that?
Yeah, hold on. Let's look at this one. Proceeds from disposal. Yeah, I would say, oh, that's kind of interesting. Right. Oh, this is really interesting. So
yeah, that's why I was. It's like they sell more than they buy, which I don't know what's going on there, but
okay. So it's weird on a quarterly. It's not that weird on a annual. Okay, you see this?
Oh, okay. I guess that makes sense. Maybe.
So just do the net acquisition of PP&E minus proceeds from disposals. Okay.
Okay, and just in general, the Capex is, you get that from the cash flow statement, right?
Yes, cash flow statement. Get that from the investing activities. And so if I'm guessing, these freight companies buy trucks new and sell them when like they're still running, but they're just kind of crappy to like independent operators, right?
Yeah,
so they still have residual value, but they never keep them until they're dead. So you want the net PP&E here. That's just a guess. You'll have to read everything to understand that. Cool. So that's latest fiscal year. Is that good, David?
Yes, that answers my question.
Cool. And then you basically do the same thing, but from the Q. So from the 10Q. So that from the quarterly, you want to go to the rightmost side to get the like year to date since the last fiscal year, right? So if you see 3 months ended and there's only a 3 months ended column, that means that this is the first Q that they are reporting since the last K. So just use that number. But if they have a 6 or 9 months ended column, then use that number, okay? So, and it already gives you to you. So 6 months ended June 30, 2020 and June 30, 2019. So revenue, you're gonna just plug that in to latest fiscal revenue, 2019. EBITDA, we have to do EBITDA separately for all of us. So EBIT, excuse me, is 11.8 plus 6 months ended, right? 6 months ended, DNA and SPC, stock-based comp. It's kind of weird to think that you guys are going to enter banking with slightly different accounting rules than I did. Getting old. It's funny, but that's why as finance people, we don't really care that much about the rules because we like free cash flow. That's why we like free cash flow yield, adjusted free cash flow yield. Because it kind of like at the end of the day, it's like how much cash does this asset spit out? Cool. So that's EBITDA. Remember, triple check your numbers. It's the biggest thing. Capex. Emotions run very high when you're working on a pitch deck at 1 a.m. in the morning for a 7 a.m. meeting. Make sure they're all positive because these are cash outflows. So that's why they're negative. Cool. So copy these formulas down, and then that should calculate last 12 months for you, which is basically your annual figures plus the year-to-date, the recent year-to-date figure minus the previous year-to-date figure. And that gets you last 12 months. And then, you know, these formulas are already calculated for you. So just copy them down, but they're essentially what these companies are trading at based on, you know, enterprise value on LTM revenue. So last 12 months revenue, last fiscal year revenue, last 12 months EBITDA, last fiscal year EBITDA, last 12 months EBITDA minus Capex, you know, over fiscal year EBITDA minus Capex and EBITDA margin. So here we see on an LTM basis, we see, so let's minimize all this. So you do this for the full industry and voila, these are your comps, right? So we would do this for a lot of companies. And so now you see Facebook is trading at a higher multiple than Apple is on a hindsight basis, but they are a pure software company, and software is generally a better type of business than hardware. Apple is a hybrid software hardware business, right? So if I were to guess, Facebook has higher growth profile than Apple. So better growth, better margins equal better, it justifies a higher enterprise value multiple or any sort of valuation multiple. And so that from here, we really see kind of a nice little picture of it. And then this is how we kind of like, if you're a sector coverage analyst, you're like, oh, this one's super interesting, right? It's too overvalued. Maybe it's a short. Or this one's super undervalued. I think it's getting beaten down for no reason. I think we should buy it or we should look into buying it as an undervalued asset. It doesn't give you the full picture. It's not a super deep dive, but it gives us a nice picture of any industry. Also, just remember, we're calculating hindsight figures when what matters is future cash flows, not previous cash flows. So when you compare Facebook on forward, they're trading at forward, call it 14 times next year's EBITDA with 50% EBITDA growth. Oh, sorry, not 50%. What would that be? About 25% EBITDA growth. So let's call it cash flow growth, versus Apple is trading at 21 times forward EBITDA. See, even they do EBITDA minus Capex. So we're not crazy here. 21 times EBITDA minus EBITDA with smaller EBITDA growth. So when I compare Apple and Facebook, I think Apple has better barriers to entry and moat and kind of just a better wholly defensible business. Facebook has better growth profiles, a better growth profile at a much cheaper price. So you're talking about 14 times forward EBITDA time, as compared to 21 times EBITDA. So all that to say is, Sentio really gives me a quick view because I see what the Wall Street analysts are projecting forward, which we don't have here. We only have backwards. So here it looks like Facebook's basically valued more than Apple on a retrospective view, when in fact Facebook's actually a discount to Apple on a forward view. And this is something that only like Wall Street sees generally, because nobody's paying for these tools. But anyway, this is still very helpful because most industries, not a lot of companies are growing at like 20% a year plus. But hopefully that's helpful. And if you are a sector analyst, hopefully you will have like your projections on these things. And we would add another column as like fiscal year +1, +2. So we would get the whole picture. But these are what you can do now until you guys really dig into until we dig into DCF stuff.
One last question. If the latest filing is the 10K, how would that affect so you wouldn't have the latest, last 12-month part?
Nope. Yep. You just delete this.
Okay.
It's the same.
Okay. That makes sense.
Right. So you'll see that these two things are the same. These two things are the same. Right. Because the latest K would be the last 12 months.
Okay. Perfect.
Cool. Hopefully that was helpful. Thank you all for sticking with me for an hour and a half. Any other last minute questions?
Yeah, I just had one really quick one. I something came up, but how did you format the multiples to become to have the X?
Oh yeah, that's a nice little question. So if I want, I already did that here. So let's say I go 0.5. Okay, so I want to format that. A little shortcut, Control-1, brings up this format cells, Control-1. Or you can go right-click, format cells. But Control-1, remember that one. Go to Custom, and I go 0.0x or 0.0000x, whatever you want, right? Or 0x, and then semicolon in parentheses 0x. So that means, semicolon, basically the first thing is what is it when it's a positive number? Second thing is what's the format if it's a negative number? And the third one is what is the format if it's 0? So here, positive, negative, 0. See that? Positive, negative, 0. And if I want a decimal, I have to go in here because there's no native format, obviously, for positive, negative, 0. Cool.
All right. Yeah. Thank you so much.
Any other questions? Good. Okay. Well, have a great night, guys.